Hello, this is the 17th episode of What Would Peter Lynch Do that explores the wisdom of the legendary investor Peter Lynch. So today we're digging into something you asked about based on the sources you sent over. It really hits on a common perception of the stock market. You mentioned hearing terms like smart money and dumb money, and well, you asked, is money itself different? And why does the money from individual investors often get tagged as dumb money?
Yeah, that's a great question. And that terminology, it can definitely feel a bit unpleasant, can't it?
It really can.
It sort of implies this, class system for money where individuals are automatically positioned to lose, like they're the designated suckers.
Exactly. It feels like the game is rigged from the start. So our mission for this deep dive, looking at the sources you gave us, is to unpack what those terms really mean, where they came from, and most importantly, drawing on Peter Lynch's insights, how you, the individual investor, can kind of flip that narrative, act more like the quote-unquote smart money, and, well, avoid those typical traps.
Okay, let's break it down based on what your sources suggest. They point out that these terms, smart money, dumb money, they weren't actually invented to insult anyone's intelligence, initially anyway. They started on Wall Street, more like shorthand. A way to describe different patterns of behavior, different levels of access to information, and frankly, the amount of capital involved.
Ah, okay. So less about actual brain power and more about typical habits and resources.
Precisely. Smart money generally refers to the big players. Think institutional investors, pension funds, mutual funds, hedge funds, that sort of thing. It also includes company insiders, executives, directors, and highly experienced professional investors.
Right.
They get called smart, not because they're infallible, but because they usually operate with certain advantages built into their position.
And what kind of advantages do the sources highlight there? What makes them smart in this context?
Well, there seem to be three main ones popping up in the materials. First, often an informational advantage. They've got access to vast amounts of data, research reports, whole teams of analysts digging into things. Stuff you or I wouldn't easily see.
Okay, makes sense. More data.
Second, capital power. We're talking huge sums of money, enough that their buying or selling can sometimes actually move the market price. Plus, they can get into investments or deals that just aren't available to smaller investors.
Like private placements or certain derivatives, maybe.
Exactly. And third, there's a tendency towards a more, let's say, rational or systematic approach. They often rely on complex models, algorithms, long-term strategic plans, trying to take the emotion out of it.
Okay, got it. Information, capital, systematic approach. So if that's smart money, then where does dumb money fit in? Is that just everyone else?
Pretty much, yeah. Dumb money is the term usually applied to retail investors. Individual people investing their own savings, especially those who might be newer to investing or let their emotions drive their decisions.
And it's called dumb because
of common mistake patterns that tend to show up more frequently in this group. Again, it's not a judgment on intelligence, more an observation of behavior.
Okay, like what kinds of mistakes are we talking about?
Well, a big one is the information disadvantage. Maybe relying too much on, say, news headlines or what's buzzing on social media instead of deeper research.
Chasing trends.
Right. Then there's emotional trading, that classic cycle. Buying high when everyone's euphoric, maybe feeling FOMO, fear of missing out.
Oh yeah, FOMO's a killer.
It is. And then panic selling low when the market dips and fear takes over.
Selling at the bottom, buying at the top. The opposite of what you want.
Exactly. And related to that is late entry, jumping onto a stock bandwagon only after it's already had a massive run-up, hoping it'll keep going forever.
So it really sounds like it's describing these behavioral pitfalls more than someone's actual IQ score.
That's the key takeaway, yes. And the sources are pretty clear. This isn't saying institutions always win or individuals always lose. It's a critique of the typical observable mistakes the average individual investor might fall into.
But here's where it gets really interesting, right? Because Peter Lynch looked at all this perceived disadvantage of the individual, and he just completely turned it on its head.
He absolutely did. Peter Lynch spent his whole career championing the individual investor. He argued quite forcefully that individuals actually hold some massive advantages over the big institutions.
Advantages? How so? It seems like institutions have all the power.
Well, Lynch believed the very things that make institutions seem smart. Their size, their need for constant trading, their focus on widely followed stocks, those are often their biggest handicaps.
Okay.
And the things that might make individuals seem dumb, like having less capital or not being glued to the market ticker, those are actually their potential superpowers if used correctly.
Right. I like that. Turning weaknesses into strengths. So let's get into those strategies Peter Lynch talked about based on the source material. How can we, as individuals, leverage these supposed weaknesses and actually invest, like smart money, using his wisdom?
Okay, strategy number one, straight from Lynch, according to these sources. Utilize your own edge. Find investment ideas where institutions aren't even looking. Your daily life.
So the dumb money move here is just blindly following Wall Street picks or news tips.
Correct. But the smart individual, following Lynch, realizes institutions are often too big to invest significantly in smaller, up-and-coming companies. That's where your edge lies. You might see a great local business thriving, or notice a new product taking off at your job, or even see what toys your kids are obsessed with. Your own real-world observations are powerful research tools.
The stuff an analyst in a skyscraper might completely miss.
Exactly. Your eyes and ears on the ground. That's a unique advantage.
Okay, that's powerful. Use your life experience. What's the next lunch strategy?
Use your most powerful weapon, time. Specifically, ignoring short-term volatility.
So the pitfall is checking your portfolio every 5 minutes, trading constantly, getting whipsawed by daily news, and racking up fees and taxes.
Precisely. That's classic dumb money behavior, often driven by anxiety. But think about the institutions. They're under intense pressure to show good performance every single quarter. They have shareholders, bosses breathing down their necks.
The short-term focus.
Very short term. But you, as an individual, you likely have a much longer time horizon. If you find a great company you understand, you can afford to be patient. You can ignore the market's daily, weekly, even yearly noise. Let the company grow over 5, 10, 15 years. That patience is a massive structural advantage over funds that have to perform now.
So their pressure is our freedom. I like that reframe. Okay,
Right.
Third strategy.
Having the courage to stand opposite the crowd, being contrarian when it counts,
Right, the typical mistake being buying when everyone's wildly optimistic and prices are sky high.
and then selling in a panic when the market crashes and everyone's terrified.
Selling low, buying high. Again,
This is pure Peter Lynch territory. The smart individual sees market panic not just as scary, but as a potential opportunity. Maybe even a once-in-a-lifetime chance to buy shares in excellent companies at bargain prices.
when there's blood in the streets.
Potentially, yes. And conversely, Lynch warned that when investing seems easy, when everyone, your neighbor, your dentist, is suddenly an expert giving stock tips, that's the time to be most cautious. It takes real courage to buy when others are fearful and to be wary when others are greedy.
Patience, using your edge, courage. What's the final key strategy highlighted in the sources?
Maintain simplicity and humility. Stick to what you understand.
The dumb money trap here is chasing complexity. Investing in complicated financial products or hot sectors you don't really get, just hoping for a quick win.
Exactly. Maybe jumping into biotech without understanding the science or complex derivatives.
Okay.
The smart individual strategy, guided by Lynch, is simple. If you can't explain to a 10-year-old what the company does, don't buy the stock.
Stick within your circle of competence.
Precisely. Focus on businesses you can genuinely grasp. And the sources also mention the humility aspect. If picking individual stocks feels overwhelming or too risky after doing your homework, then consistently investing in a simple, low-cost, broad market index fund like an S&P 500 ETF is a perfectly smart, rational, and often very effective long-term strategy. No shame in that game.
So, looking back at all this, it seems dumb money isn't about lack of intelligence at all. It's really about these flawed behavioral patterns, letting emotions, impatience, and hype drive decisions.
That's exactly what the sources and Peter Lynch's philosophy suggest, and his core message is incredibly optimistic. By avoiding those common behavioral traps and actively leveraging your unique advantages as an individual, advantages like your real-world perspective, your long time horizon, your patience, your freedom from institutional pressures, you're actually incredibly well-positioned to succeed, maybe even outperform the big guys.
Okay, now earlier, you brought up a really sharp point about information. You asked, essentially, with the internet and everything, hasn't that old problem of information asymmetry, institutions knowing stuff individuals don't kind of gone away?
Yeah, it's a fair question. I mean, basic financial data is everywhere now, right? Anyone can look up earnings reports, balance sheets.
Totally.
Yeah.
So is the playing field level now?
Well, according to the sources we looked at, not quite. It's true that baseline access is way higher, but the asymmetry hasn't disappeared. It's just evolved, it's shifted.
Shifted how?
The edge today isn't just about having the basic info anymore. It's about having different kinds of information, getting it faster, and having much more powerful tools to analyze it.
Okay, so the gap's still there, just looks different. What are these new dimensions of asymmetry?
The sources point to a few things. First, there's the speed advantage. We touched on this. High-frequency trading, or HFT.
Right.
Institutions literally place their computer servers in the same building as the stock exchange servers. Co-location. This lets them react to news and place trades in microseconds or milliseconds, way, way faster than any human possibly could clicking a mouse at home.
Milliseconds. It's like an arms race in speed.
It really is. Plus, they pay for expensive, dedicated data feeds, Bloomberg, Reuters, etc., that deliver raw market data and news faster and less filtered than the free sources most individuals rely on.
Speed kills in this context.
Okay, speed is one dimension. What else?
The second is depth and exclusivity. This is where alternative data comes in. It's using non-traditional data sources to get an edge.
Alternative data, like what?
All sorts of things. The sources mentioned using satellite imagery seriously to count cars in Walmart parking lots before earnings are announced, trying to estimate foot traffic and sales.
Wow, okay, that's creative. Or analyzing huge data sets of anonymized credit card transactions to see spending trends at specific retailers or restaurants in almost real time. Tracking website traffic, mobile app downloads, social media sentiment, even analyzing supply chain data.
So finding clues about business performance before the official numbers come out, using data that isn't in the standard reports.
Exactly. It's about getting an early, often predictive read. And the sources also mention corporate access. Big institutions get to have meetings with CEOs and CFOs.
Right, the analyst call.
Even beyond that, private meetings. Now, legally, management can't share material non-public info, but the nuances, the tone, the body language, the answers to specific probing questions, that can provide subtle insights, a feel for the business that you just don't get from reading a press release.
That makes sense. A qualitative edge. And the third dimension of this new asymmetry.
It's the analysis and processing power advantage. Basically, humans versus machines, or humans aided by incredibly powerful machines. Institutions employ teams of quants, often PhDs in physics, math, computer science, building sophisticated algorithms. These algorithms can analyze millions of data points simultaneously, news articles, social media posts, all that alternative data, market prices looking for patterns, correlations, signals that are simply invisible to the human eye.
So we can process way more information, way faster.
And find connections we wouldn't. There's also this trend called quantimental investing, which tries to blend the best of both worlds. Traditional human analyst research combined with insights from this massive quantitative data processing.
Okay, so it definitely sounds like even with more data out there, the institutions have found new ways to create an edge through speed, unique data, and sheer processing power. But does that mean finding those huge winners, those 10-baggers Peter Lynch famously talked about, stocks that go up 10 times or more, is now basically impossible for an individual? Does it feel like all the big gains are captured by venture capitalists before a company even goes public? You raise this concern?
That's a really common feeling, isn't it? That all the exciting growth happens privately, and by the time a company hits the public market via an IPO, the easy money's been made.
Yeah, exactly.
But here again, Peter Lynch, according to these sources, strongly disagrees. He was adamant. Most 10-baggers are found in the public market after they have already gone public.
Really? He thought the public market was better for finding them.
He did. The sources really emphasize shattering this pre-IPO illusion. An initial public offering, an IPO, isn't the finish line. Often, it's the starting gun for the next phase of major growth.
How so?
Companies usually go public specifically to raise large amounts of capital to fund future expansion, innovation, acquisitions. Think about the biggest tech giants, Amazon, Google, Microsoft. Their most explosive growth, the returns that made them 10-baggers many times over, happened after they were already public companies.
That's a great point. The IPO fuels the next stage.
Exactly. And the sources also point out that venture capital, that pre-IPO world, is extremely risky. It's a home run hitter's game, they call it. Lots of strikeouts. For every huge success, there are many, many failures. That level of risk isn't appropriate for most individual investors' core savings.
Okay, so if the public market is where Lynch thought we should look for 10-baggers, how did he suggest we find them? What was his method?
He had this sort of scouting method, as the sources describe it, a few key approaches.
All right, let's hear them.
First, look for niche market dominators. Lynch loved finding relatively small companies, often ignored by Wall Street analysts because they were too small, that absolutely dominated a specific, often overlooked market niche.
Like a specialized software provider or a regional leader in some service.
Could be anything. Something you might know about because it's related to your industry, your profession, or even a serious hobby. Again, institutions are often too big to invest meaningfully in a company with, say, only a $300 million market cap. But for you, finding a small company that's the absolute leader in its specific pond can be incredibly lucrative if that pond grows.
Find the big fish in the small, overlooked ponds.
Got it.
What else?
Second, find treasure hidden in boredom. Wall Street loves hype, exciting stories, disruptive tech, the next big thing. Lynch often looked in the opposite direction towards simple, understandable, even downright boring businesses.
Boring. Like what?
Think about companies involved in waste management, funeral services, manufacturing essential but unglamorous parts, maybe cardboard box makers. These businesses might not make headlines, but they often provide essential services, face less intense competition, generate steady cash flow, and can quietly compound wealth for years and years.
Less excitement, but maybe more reliable growth. Makes sense. Any other scouting tips?
Yes. The third one is about timing. Wait for Act 2 of the story. Sometimes the best opportunities come not from finding something brand new, but from finding a company that's reinventing itself or starting a new chapter after being overlooked or written off.
Act 2.
Yeah, two main types here, according to the sources. Turnarounds and spin-offs.
Okay.
Turnarounds are companies that were in trouble, maybe bad management, outdated products, losing money, but are now under new leadership or have a new strategy that's starting to work. As an individual, maybe shopping there, using their service, you might notice improvements on the ground, better products, happier employees, cleaner stores before the financial results fully reflect it and Wall Street catches on.
Seeing the green shoots first.
Exactly. And spin-offs are when a large corporation decides to divest a part of its business, creating a new, independent, publicly traded company. Often, that spun-off unit was kind of neglected or overshadowed within the giant parent company. But once it's free, with its own focused management and incentives, its potential can suddenly be unleashed. These can be hidden gems.
That's fascinating. So niche dominators, boring businesses, and second acts like turnarounds and spin-offs. It really paints a picture of active searching, but in places maybe the crowd isn't looking.
Absolutely. And it circles back to the main theme, doesn't it? What Peter Lynch was saying, channeled through these sources, is that your perceived weaknesses being small, maybe feeling like you get information late, not having institutional resources, these aren't necessarily liabilities.
Their strength.
They can be your greatest strengths.
Okay.
Thinking you get information late means, as Lynch saw it, you are free from the noise and madness of Wall Street. You're not forced to react to every flicker. Thinking your capital is small means you can invest in small, flexible, promising stocks that institutions can't even look at. You have agility they lack.
So being small and late gives you freedom and focus.
That's the idea. The secret to finding those 10 baggers, in Lynch's view, wasn't about having secret pre-IPO access. It was about having an explorer's spirit in the public market, being curious, observant, patient, and looking for great businesses where others aren't. The next potential 10-bagger could genuinely be a company you interact with every day.
This whole deep dive has really reframed that smart versus dumb money idea. It's not about who's smarter. It's about behavior, access, and crucially, how you play the game based on the advantages you do have. And Peter Lynch's whole philosophy seems to be about empowering the individual by showing them their unique advantages. Patience, real-world insight, flexibility are incredibly powerful tools.
I will say a word from Peter Lynch today and say that this principle is connected not only to investment decisions, but also to life wisdom.
That's a really great connection. Thinking about it, being patient when everyone else is rushing, trusting your own judgment and observations instead of just following the herd, having the courage to act differently. These aren't just investing principles, are they?
Not at all. They apply everywhere. Business, career choices, even personal relationships sometimes.
Yes, yeah.
Knowing your own strengths, playing your own game, not getting swept up in external noise, that's valuable wisdom for life, period.
Absolutely. Well, this has been incredibly insightful. Thank you.
See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice